1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that has done well in the past, but anticipating the future performance of one is much more difficult. If you want to be successful in investing in stocks, you must be prepared to do a lot of work analyzing a business and managing the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual, so it's a very difficult game for the individual to win over time, says Dan Keaty, CFP, Chief Financial Planning Strategist at TIAA. If you are analyzing a company, you might want to look at the fundamentals, earnings per share or price/earnings, for example. But you will have to do a lot more: analyze the management team of the company, assess its competitive advantages, study its including its balance sheet and income statement. Even these items are just the start. Keaty says going out and buying stock in your favorite product or company isn't the right way to go about investing. Also, don't rely too much on performance because it's not future-proof. You'll have to study the company and anticipate what's coming next. 2. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. What they forget about is that often they're not talking about those particular investments that they also own that did very, very poorly over time, Keaty says. So sometimes people have unrealistic expectations about the kind of return they can achieve in the market. And sometimes they confuse luck with skill. You can sometimes get lucky choosing individual stock. It's hard to get lucky over time and avoid those big slowdowns as well. An alternative to individual stocks is an index fund, can be either a mutual fund or exchange-traded fund. These funds hold dozens or even hundreds of stocks. And every stock you buy from a fund owns the companies included in the index. 3. Avoid short-term trading. Understanding whether you are investing for the long term or for the term can also help determine your strategy, whether you should invest at all. Sometimes short-term investors can be unrealistic about how their money will grow. And research shows that most short-term investors, such as day traders, lose money. You are competing with powerful investors and well-programmed computers who can better understand the market. New investors should be aware that frequent buying and selling of stocks can be expensive. This can create taxes and other fees. Even a broker's overall trading commission is zero. If you invest for the short term, you may not have your money when you need it. 4. Try a stock market simulator before investing real money. One way to enter the world of investing risk-free is to use a stock simulator. Using an online trading account with virtuals will not put your real money at risk. You will also be able to determine how you would react if it was your money that you won or lost. That can be really helpful because it can help people overcome the belief that they're smarter than the market, Keaty says. That they can always pick the best stocks, always buy and sell in the market at the right time. Asking yourself why you are investing can help you decide if investing in stocks is right for you. 5. Start now. Choosing the perfect opportunities to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in. And investing is meant to be a long-term activity. There is no perfect time to start. One of the core points with investing is not just to think about it, but to get started, Keaty says. And start now. Because if you invest now, and often over time, that compounding is the thing that can really drive your results. If you want to invest, it's very important to actually get started and have an ongoing savings program so that we can reach our goals over time.